You said I would never pay full market price for a deal.
Absolutely.
I don't hear that from everyone.
Margin of safety. The way you should get into real estate at this point in time is through sweat equity. Capital preservation is very important. Cash is king. No matter how smart you are, how experienced you are, it is an extremely risky bet.
Welcome back to the Roots Podcast. I am your host, Tyler Lingle, along with my co-host, Max Moore. And today we have on Sib Sheikh. Sib recently made a bold pivot from leading real estate development projects as VP at Helix to helping families and business owners build lasting wealth. With a deep experience in multifamily, mixed use, and affordable housing, including public-private partnerships, he now focuses on exit planning, tax strategy, and generational wealth preservation. He holds an MBA from Duke. He's a CFA charter holder and brings a rare blend of street smart investing and institutional financial chops. Whether structuring deals for optimizing portfolio, he's spent his career bridging development and finance. He also serves as board treasurer for HOPE, CDC, advancing affordable senior housing across Indianapolis, and has a global perspective shaped by travel, service, and entrepreneurship. Hopefully blew enough sunshine up your shorts for one day. Welcome to the show, Sib.
Such an honor and pleasure. Thanks for having me.
Thanks for coming on. If I had $50,000 in my pocket, owned no real estate, and I wanted to break in, how should I deploy that?
You know what? I would suggest, given the current economic environment, given the current interest rate environment, cost structure, and uncertainty, hold on to that $50,000. However, the way you should get into real estate at this point in time is through sweat equity. It could be either managing properties on your behalf or somebody else's behalf, shadowing other successful developers that are 10, 20 years ahead of where you want to be today. Because again, capital preservation is very important. Cash is king. So you always have to be very strategic and very thoughtful about how you're deploying that capital. But more so at this point in time in our economic cycle and real estate cycle.
And what about this current moment in the real estate market cycle makes you believe that it'd be better to hold that cash, store it up for later? What are the factors at play there?
Absolutely. So again, the way the real estate cycle works is that when interest rates are low, when there's cap rate compression going on in the real estate market, when the tide is in your favor, you can do no wrong. Just some basic common sense will take you a long way. And on the flip side, when the real estate cycle has turned at a point where interest rates are high, when your input costs are high, labor costs are high, there's economic uncertainty, instead of cap rate compression, there's cap rate expansion, which is leading to valuations either being uncertain or going down. At that point, no matter how smart you are, how experienced you are, it is an extremely risky bet. You can obviously still make money in real estate. There's always going to be pockets of opportunity, but to prioritize risk mitigation and to maintain enough buffer, it is critical that at different points in time in the cycle, you have a different strategy and different approach. You should still always remain in the market. It's never wise to take a step back if times are tough. You just pivot and reprioritize what your methodology and focus is. And at this point in time, I think sweat equity for somebody that has $50,000 set aside would be the best approach. Again, joining a larger team in any capacity, whether it's providing informal support, whether it's becoming their employee or an independent contractor, or just having a mentor-mentee relationship, shadowing people that are already established, already have enough of a capital buffer, enough of a financial buffer that they're being able to ride out this real estate challenging time in the real estate market and some of the storms that are brewing. Because the worst thing that you could do is destroy that capital, because then you're completely out of the game. You want to stay in the game. You want to stay in the game for the long term. So risk mitigation at any point in your investment career is critical, but even more so at this point in time.
So what I'm hearing for listeners and what I'm taking away is interest rates are higher. There's been cap rate expansion, not compression. And right now, 50K could get just swept away quite easily because there's a lot of wealth stagnation decline versus wealth creation. It's interesting because it seems to go counter to the narrative time in the market versus timing the market.
Yeah.
How would you?
No, I completely agree with the thesis that time in the market. But again, the time in the market doesn't necessarily have to be your financial capital. It can be your personal capital, your sweat equity. You want to stay in the market, but again, more in a role without putting your money at risk. Again, whether it's other people's money, you're coming in because again, if you're diversifying the risk, spreading that risk out into multiple parties, again, instead of putting all your eggs in one basket, I would say that allocate maybe part of that capital if you do want to put that capital at risk, but more in a partnership setting, more in a syndication setting. Any approach that helps you minimize your risk exposure at this stage is advisable. Because the reality is that whenever you're doing a business venture, whenever you're doing a real estate venture, you are taking risk. And so risk minimization and risk mitigation are important tools. But that risk is high at certain points in the cycle. The risk is much lower in other points in the cycle. My suggestion would be that at this point, minimizing capital exposure for somebody that has $50K to play with would be the best strategy. But again, while still stressing that there's no substitute to time in the market.
When I have 50K, I'm excited. Sib's telling me to stay on the sidelines a bit longer and maybe manage or shadow someone, which is great advice. When would I know it's the time? Like, when do I jump in and either get in that syndication deal or buy the duplex or whatever?
Absolutely. So studying the macro environment is key in that. Real estate is very unique from the perspective that while in the broader markets or broader asset classes, the macro environment plays a big role. Real estate can also be very micro. It can literally vary from block to block. You can always find those needles in the haystack, even in this market. So again, I do want to caveat by saying that if you do find that amazing, too good to be true deal, go for it. But it has to be fully vetted, fully thought through. The risk has to be fully quantified and analyzed. Going back to your original question, again, since the macro environment is so important to study, some of the things that we're seeing right now is valuations are pretty high. Banks are kicking the can down the road. Extend and pretend is what they're calling it, because there's a lot of loans that are coming due. Banks are in the short term kind of kicking that can down the road. So there's not been a lot of price discovery in the real estate market over the last year or two. So the prices that are on people's books right now, the valuations that are on people's books and on banks' balance sheets, the risk is that if we do hit a contraction, if interest rates stay higher for longer, eventually there would be some kind of reckoning. That's obviously all conjecture at this point in time. But I do want to say, and obviously I want to caveat with the fact that not giving any advice, not giving any financial advice, because given the role as a private wealth manager, we are constrained in what advice we can give in public settings. So with that caveat, just speaking in general terms, at this point in time, be very cognizant of basically what the macro environment is, what the high interest rate impact would be if this do stay high for longer. You could see where banks are starting to get distressed, investors are starting to get distressed, and if a lot of that happens, valuations might come down. There might be distressed sales as well, and those are good opportunities then to jump in the market. But once that situation's fully baked in, there's still obviously one-off situations happening where sellers are getting distressed for various reasons and wanting to sell. But a lot of investors are holding on. A lot of sellers are holding on and waiting and seeing and hoping that things would turn around. But eventually, obviously, they might have to basically reconsider. And that's obviously reminiscent of how 2008 through 2010 was as well. Obviously,
well, you told me that you've never bought a deal where the seller wasn't, you've never bought a deal that you didn't have a good equity position in,
Absolutely.
Meaning getting it at a discount. I thought that was really interesting. You said I would never pay full market price for a deal.
Absolutely.
I don't hear that from everyone.
Yeah.
By the way.
Yeah. Margin of safety. That's the golden rule in any form of investing, and especially in real estate as well. That is something that obviously all sorts of investors, ranging from Warren Buffett to top real estate investors as well, they ensure that in any deal, they're maintaining a big margin of safety. And that can come through different ways. Generally, you don't want to pay market price for something. You want to pay below market price for something. And that's what creates that initial buffer, and that's what creates immediate equity in the deal as well. If you buy something that is worth $1 million and you pay $1 million for it, you're not really creating immediate equity in it. But if you buy something for $800,000 that is worth $1 million, all of a sudden you have the margin of safety and you have immediate equity in it as well. So that's what savvy investors are shooting for. And obviously, when times do get stressful, when the markets do get distressed, those opportunities increase. Right now, we're not seeing a lot of that because, again, there's a lot of extend and pretend going on. But eventually, when realization starts to hit for lenders and for investors, those valuations can come down temporarily. And then, obviously, those are good opportunities to get into the market as well. But I would, again, caveat by saying that since real estate really is very local, there's always going to be opportunities that come up. Again, any kind of distress situation, a death, a divorce, a bankruptcy, all of those things create opportunities where you can pick up something for below market price. And because, again, there's a lot of uncertainty in investing. There's a lot of uncertainty in development. If your pro forma that you put on your Excel spreadsheet never really materializes in the form that you had put it on paper, there's going to be assumptions that come in reality, come in above expectation. There's going to be things that are going to come in below expectation. You might think that you're going to pick up a house for $70,000. You're going to rehab it, put in another $70,000 in it. Well, that $70,000 might end up being $100,000. So without having a margin of safety and buffer up front, you end up taking risks. So the more you can mitigate uncertainty by creating that initial margin of safety based on the original price that you're paying, the assumption that you have about how much it's going to cost to fix up, how long it's going to take to fix up, all of those things, what you're going to be able to eventually sell it for. If you are conservative in all those estimates, having the costs be estimated at more than what you think they'll be, and having the revenues or the sales price, the rents, all of them, at least for your pro forma, be below what you truly think them to be. And even after all of that, if the pro forma turns out to be positive, then I think you have ample margin of safety, and that's a safe bet to do.
I think right now, I can't remember where I saw this, but America's equity is just going completely by the wayside. Like, wealth is being demolished in huge waves currently. So what I hear you saying is, like, you're getting into the game so that you're near, because if you're not near, I don't think you would find one of those deals to break in. So you've got the $50K in your pocket plus experience, plus you're close to really good depressed deals. I think discipline. Savvy investors have discipline to find those. It's very easy to make shift in Excel, right? To make it look like you want it to. We all can have cash flow in our Excel.
Yeah, absolutely. Excel is an important tool, but the gut instinct that you develop through experience, I think that's gold. Yeah. So, and that can only be gained through personal experience and learning and listening and absorbing other people's experience. So that's why these kind of podcasts, I think you guys talking to people who've already gained that experience is going to develop that gut instinct for you. Yeah.
I think you need to go before you jump in, because, Sib said, if I run the pro forma conservative, go buy it. Yeah, that's true. But you need to analyze 100 deals. You need to walk 50 deals with your agent. You need to actually get in the game and become as close to a market expert as you can. You won't be an expert till you buy, because you learn everything after you do your first deal. Yeah. You actually have you have a semblance of knowledge before, but at least pretending as if you're going through it, and getting in properties, that's the step. We get a lot of Zillow people. They have 5 searches on Zillow, and they're watching Grant Cardone. They're watching whatever, all these guys on YouTube.
Yeah.
They're watching us on YouTube.
Yeah.
They've spent 5-10 years. They're not ever gonna do it.
Yeah.
And so there is a level of like analyze up to a certain point, and when you have that gut instinct, jump off and realize that you will learn a lot.
Yeah.
Like every deal I've done, I've learned a substantial amount to the point where like I actually say no to 99.5% of things I see, I would say.
Absolutely.
I can't,
Absolutely.
I agree with you. I don't see tons of and look, we're realtors. Look over here. We're selling, I don't see shiny, oh, this is an amazing deal. I'm gonna jump in and do this. Cause I know, like there's something that could go off about that property, or like the type of tenant you're gonna get, or you're not seeing this. But there is that 1% that's like, wow, if I don't get that deal, there's this duplex on College Ave. If I don't, that's going to bother me in 10 years.
Yeah.
I'm going to see what it's worth, and I'll be like, I should have bought that.
Absolutely.
And that's that gut feeling.
Absolutely.
Just affirming that.
Yeah, no, you're spot on. Because I think what happens is that a lot of us do struggle with analysis paralysis. Some people are thinkers, some people are doers. You want to be the doer. Thinking is good, analyzing is good, but up till a certain point in time, constant movement is key. And you want to avoid analysis paralysis, because then you're not going to do anything. What does not kill you makes you stronger. So that's the key right there, that you want to be doing stuff. Each experience is going to make you stronger, as long as you don't overextend yourself so much that it kills you and gets you out of the game in terms of you losing all your capital. So that's why when the environment is riskier than on average, you want to be highly cautious of your own capital while still ensuring that you are involved in some capacity in the market. And I think that's where two fields that I feel are just amazing for people that are just starting out, don't have a lot of capital: real estate brokerage, property management. Those two things help you be right at the tip of the spear, see exactly what the action is, helps you rub shoulders with investors, with buyers, with sellers. You're able to develop a network, relationships, connections. You're also able to talk to a lot of people that are buying and selling and learn from them, have conversations with them. So real estate brokerage and property management, I think that's an amazing entry point for a lot of people that want to make money in real estate but don't have the capital yet. So, and especially in times like these, that helps you stay involved and active in the market without putting your own capital at risk. And again, ensuring that you're getting stronger with each experience without, being pushed out of the game because you've lost all your capital.
Yeah, the property management piece, I want to stick on that. You're forced to drive for dollars. You have to be out in the streets, right?
Oh, yeah, you got to hustle.
That's where you find all the opportunity.
Yeah.
It's funny, though. What I see most do is go work for a wholesaler, and they start going straight to the pawn shop, straight to the bottom of the barrel, as opposed to where you could just go and be the guy changing the locks for the property management company. Is going to serve you better than convincing grandma to sell their house to whoever and daisy chain deals up.
Yeah.
Where's the perspective for you come from? Where's your housing start?
Yeah. So, sticking with the point of wholesale versus something like property management, one thing that I wanted to share regarding that was that out of all the different asset classes that are out there, real estate is the most tax-friendly asset class. But the only way you're able to achieve that is if you're not flipping. Flipping is a good learning experience, but long-term wealth is generated by buying and owning and renting it for the long term. And again, buying properties that are cash flowing, and then you're like growing their value that way over the long run. Because when you're wholesaling and you're flipping, you are basically paying ordinary income tax on it, which is 37% for the highest bracket. When you buy and hold and rent it out, there's multiple tax benefits that come with it. First of all, you get depreciation deductions that basically wipe out, if not all, then most of your income. So you're getting the cash flow, but not really showing any income to go with that. Also, it's considered passive income, so you're not paying self-employment tax, which is, again, 15%. So not only are you not paying the federal income tax, you're not paying the self-employment tax. Right there, that is massive, massive saving. two people could have the same gross amount in wholesaling and being, again, a landlord, but the net amount is going to be drastically different. The net amount is going to be 40-50% higher after taxes for the landlord. And when you sell it, even at that time, there's multiple opportunities. Obviously, ideally, you don't want to sell it although I've sold plenty in my career, and there's strategic reasons for that. But you want to minimize selling. But when you do sell, 1031 exchange is a great way of doing it. You basically defer capital gains on it. And even if you do end up taking capital gains, that's again staggered between 0%, 10%, just 0, 15, and 20%. And then if it's really above a certain income level, then you have the net investment income tax as well, which is 3.8%. But overall, you'll be paying, worst case, 23.8% capital gains plus the net investment income tax at a sale on your gains. And then obviously depreciation deduction is at 25%. But like, long story short, that is still a much lower interest rate.
This is
tax
all
rate.
great if your tenant pays their rent check.
That's where your experience as a property manager comes into play.
Right.
That's where you experience that gut that you develop about the right asset, the right tenant. So and that's the old adage that in real estate investing, again, as a landlord, the money is made and lost in property management.
The only thing I want to get to Max's question on your experiences, we're going super high level across people's heads. Hope people are hanging on. But the only thing I'll say about rentals is for a lot of the people that we've helped start, they bought maybe a single, we're like the entry to real estate for a lot of people. Educational brokerage, right?
Yeah.
It's the whole shtick. They bought a single family, then maybe a duplex, then a quad, then a small part. It's in my experience, and that's been my trajectory, it's when I see the equity and what I could if I sold them, I'm like, whoa, I could take possibly multiple years off work. That's amazing. That's awesome at age 30. When I see the net rental amount, I get depressed.
Yeah.
And that's everyone. And so it's like, I feel like rentals are a slow way to build wealth, yet a very powerful way to build wealth in the long run.
Yeah.
But sometimes I look at dollar per hour when I'm calling plumbers or whatever. Now I have a property manager to help with that, but even managing the manager, dollar per hour, it's hard for me to justify some of the rental work to where sitting here right now, I had a conversation with Max on, should I just sell off all these? And because I could go to brokerage and make, just make more money quicker with the types of phone calls and work. That's a real struggle I have where I am at age 30 actually, is how long to hold these rentals, how to value that cash flow versus long-term wealth. And I think a lot of our clients and listeners are in that boat where like they've been told, buy rentals, buy and hold. They get into it, they're like, where's the money?
A
lot of people feel that.
And that's where, again, it is a cyclical industry. Back in 2008, 2010, when I got in, values had crashed to a point at that time where that differential, that ROI was still very healthy, where you were generating quite a bit of cash flow from owning. It's all a matter of your basis, what you're buying the property for and what you're being able to rent it at. So that's your ROI right there. And to your point, the ROI is not there right now. And it's a function of the cycle. So in these moments, you got to be obviously cognizant and realistic about like what the best opportunities are at that point in time. But the reality is that you are getting a huge haircut when you do sell. Again, even if on paper, pre-sale, your gross gains on it are a certain amount. Once you've basically paid taxes on it, you're getting especially because there will be ordinary income tax plus self-employment tax on top of that, because it's not considered passive income, unlike with rentals. So you need to be looking at it from an after-tax perspective. And again, if the property has enough of fair market value that you're being able to get a big paycheck by selling it, you could basically get a bigger loan, get your equity out through refinancing. Obviously, that's not working well right now because of high interest rates as well. But the good thing about interest rates and about loans is that you marry the property and date the rate. So in the sense that like you can always, even if you're locking in a higher interest rate right now, you can refinance later when rates come down, which again has been a slow process. And that's the big challenge of our age right now, that when are rates going to come down? Because by all expectations, they were supposed to start coming down by now. But buying and owning for the long term and renting does become more and more of a viable option when interest rates are lower.
Hey, I want to interrupt this episode.
We have no sponsors on this show. It's completely free. Just Max and I trying to teach people how to build wealth through real estate. However, we do have an ask for you.
The best way that you can support us in growing is by sharing this to a like-minded individual.
All right, that's it. Back to the rest of the episode.
The comparison of if you looked at how much your active income is in being a broker with rental, without rental, I don't think that you would ever second guess the reason why you own rental.
Anyone who is a real estate agent should absolutely be buying real estate for themselves.
It's actually
just for
gross
the tax
how many
reasons.
don't even own homes.
They could not pay federal income if they know how to do it right.
Exactly.
It's
exactly.
like, you know.
Yeah, and again, for the audience, if you're a broker, then from the IRS's perspective, you're considered real estate professional. And what that means is that any losses you have on your rentals, so the depreciation deductions, once they write off the rental income, any additional depreciation that you might have left, you can actually write off your brokerage income from that as well, because those losses are considered active losses instead of passive losses. And that is something that is only available to real estate professionals. That is not available to the average Joe that might be a landlord.
Well, even I did my first cost segregation study with a cool program. I didn't go the expensive, hire the accountant. I just did a software, but it produced like a $20K deduction,
absolutely,
and applied that against my active income. And I have people are telling me I'm writing 6-figure checks in taxes. I'm like, you need to own more real estate. This is what unlocks that savings and deductions. There's so many.
Absolutely. And this new big, beautiful bill that got passed, bonus depreciation had come down to around 60% in 2025. They're bringing that back up to 100%. So what that means is that if you do a cost segregation study, the personal property, you can, the personal property portion of the real estate that you buy, again, the HVAC system, the windows, the carpet, you can set aside that cost and expense 100% of it the first year. And again, as a real estate professional, you can write off your other income against that as well and basically not have to pay any taxes in that situation. So those are very powerful benefits that the tax code provides only to real estate investing for the long term. Wholesaling and flipping, I think, again, there's opportunities and times. Again, I've done that in the past as well. You have to be opportunistic and practical about when the opportunity arises, while still staying principled and disciplined about what really makes wealth long term. So it's finding that balance and kind of adjusting the balance based on the economic situations of the time. But I can see where, since property prices are so inflated right now, while the consumer is getting distressed to the point that you're not seeing the rent increases on a year-to-year basis that you were seeing a couple of years ago, the ROI right now definitely is pretty compressed on these deals, where what you can buy a property for versus what you can rent it for. You're not seeing like the
but it won't matter in 10 years. Everyone's going to say, oh, I should have bought in 2025, right? It's
absolutely.
always a review. So
with the real estate, like the fact is that over time, the dollar does weaken. Over time, we do have inflation over time, no matter what asset you buy, and especially real estate bought in good locations that are going to grow, that are going to attract people over time, that are going to get gentrified over time. All of those things lead to property value increasing over time. So as long as the macro factors you're being cognizant of, that is this area going to grow over the coming years versus is it going to shrink over the coming years? Where is the job situation headed, population growth headed in that particular zip code or that particular block? That's going to make a lot of difference on how the value is going to be in the long term.
That was just a masterclass on how to use capital to build wealth in real estate. And I didn't expect it to be buy and hold and leverage the tax benefits, but like it makes sense. It's
definitely been the formula for a lot of people that have gotten very wealthy with real estate. Again, it is there's no one panacea or just golden ticket. You gotta be very obviously practical about where the opportunities are. There'll always be exceptions to the rule, but like generally, this has been the tried and tested method of growth over time.
So what makes a good deal then? What's the cash flow number, rent to price ratio?
Again, it's going to be very asset specific.
Like single family rental will go as basic gets.
So I'll be candid that single family rentals is something that I've not done a lot of. I've generally done multifamily acquisition rehabs, ground up construction. Also, the assets that I've been focused on have ranged. And again, it's purely based on the opportunity. I've done mixed use as well. I've done purely retail as well. Thankfully, I've stayed away from office because that's obviously been challenging. Industrial was very hot at a point in time post-COVID, but now that's obviously had its challenges as well. But yeah, you got to see within the different asset classes which one is providing the best ROI and then focus on that. But if you want to stick within the single family rental space, you have to go with the comps of what's available and what's producing the money. But I would encourage you guys to have a broader perspective because based on the location, based on the point in time, some asset classes perform much better than single family rentals. Single family rentals obviously are a good entry point, but you always have to have an eye for the future. You don't want to become like just with an expert in that one space. Being a real estate professional, you want to be learning and growing in different fields.
We had an investor on our podcast that started with single family rentals. 1% rule, did the BRRRR. He would put capital into it, put 150 into it, refinance it for 200, rinse and repeat.
Yeah.
Eventually he got up to 60, 70 rentals. And he was like, yeah, this is some decent cash flow.
Yeah.
He 1031'd into a wedding venue.
Yeah.
Now he's making $100K net a year, or more than, $1 million, I think, net from the wedding venue. So the point and the moral to the story is it's not always achievable for us to go buy the apartment building day one.
Yeah, it's a stepping stone. It's a stepping stone.
It's a stepping stone, right? To build equity. Our position is that single family home, you might even buy as your own primary home, will be either your number one or number two largest store of wealth, likely within that first 10 years that you own it. And if you just look at it, the people's home is usually, if it's either their retirement account or their home, it's their largest store of wealth. So in both of our stories, we wouldn't have had capital to get into investing without our own home. It was the way we did sweat equity, right? It was the way we had opportunity. And I still believe that with that 50K or however much someone has, I think you're always going to have a line item for housing. Turn the liability, the rental, into an asset, buy a home, do the sweat equity into it. And then maybe it's not, hey, I'm going to go flip, I'm going to go buy this investment property. It's just, I needed a home anyways. So let me turn my liability into an asset, right? And have that compounding and building equity to then jump on these more opportunistic plays as you're speaking to.
No, absolutely. I would say that like the 50K, once you've deployed it, it's gone. So all the future opportunities, obviously, they'll all be with sweat equity in that situation. So pretty quick, you'll end up being in that same place, especially if your goal is to have real estate be the catalyst for exponential wealth building over time. So that 50K in the bigger scheme of things, unless you're being very strategic about it, will not help you achieve that goal of making tons of wealth in a very short span of time in real estate. Sweat equity is the one that is going to always get you there. I'll give you a few examples. Again, that wedding venue that you mentioned, obviously it is with most people's existing liquid assets, it's not possible for that to be their first investment. But what they can do is with sweat equity, find those kind of opportunities. It doesn't even have to be a triple net lease like a wedding venue or, again, an industrial building or, again, just a strip center or something. It could be a self-storage and all of that. Finding those locations, those opportunities, those assets, bringing them to the attention of investors, getting ownership interest based on your sweat equity in that deal, and again, using other people's money. Come again?
Bird dog. That's what.
Yeah.
It's being the deal finder.
Absolutely. So I think that if you are investing in that growth
So,
and that learning.
Let me ask you this, because I think everyone agrees we want to find really good deals. Where would you give me one ABCs? 1, 2. Where do I go find new deals?
Yeah.
Hey, Sib, I'm looking on LoopNet every day. It's garbage.
Yeah.
Where do I find a good deal?
Yeah.
Oh, single family, multifamily. I don't care. Where's the good deals?
Yeah.
What would you do if you're restarting again?
Yeah.
And you had capital, more than 50K.
Absolutely.
Serious capital. You want to build wealth in real estate. Where would you be looking for deals?
So for me, I had gotten to a point where since, based on the background that I had, and I had worked in corporate finance, I had accumulated enough capital that my first few deals were slightly larger deals. That put me on the map, and I started in Bloomington. And so my route was atypical, so I'll mention that, but then I'll mention...
Let's hear it.
Yeah, so my route was, again... I was able to invest right off the bat in some larger multifamily projects in Bloomington. And Bloomington is small enough that word spreads pretty fast. And then brokers were bringing, again, these deals that had not hit the market yet. They were bringing them to me, and that allowed me or gave me the flexibility to sift through and find the good deals. But for most people, I think that's where the property management and brokerage fields are so good, because it really is a moving target about where the next good deal or that good opportunity or that good asset class is going to be. If you have your ear to the ground as a broker, you know where the opportunities are headed, where the investors are headed, where the interest is for people, for buyers. And that allows you to be ahead of the curve and preempt those opportunities. You might know of an investor who's a client of yours as a broker who's looking for XYZ type asset. That would give you a good idea. Okay, these kind of assets are in demand or hot for investors. You find it, lock it in through an option, or again with a PSA that is assignable, purchase and sales agreement that is assignable. Get it that way, and then again present it to investors, but find a deal that is too good to be true in terms of it's a great location. It is exactly what those investors were looking for based on your prior conversations with them as their broker, and present it to them, but ask for some sweat equity. And I've seen that happen quite a bit, where when you bring a deal to them and you're willing to do the work for them. And a lot of these investors, whether they're executives, business owners, physicians, they have their day jobs. They're looking for somebody who can find them amazing deals and run with it. So they're willing to share the ownership with them in those situations. My experience has been that that's a faster way of growing wealth, because buying single family rentals slowly, steadily over time, again, buying something, improving the value in it so you can refinance and get your equity out and buy another property with that and go like that. After 2008, 2010, after that crash, there was a big window where that was a great opportunity. Now those deals are harder to find, but obviously things do move in cycles, so that opportunity would come back again. But for right now, I feel that that opportunity is not as easy to implement as a lot of friends were able to achieve it, again, in early 2010s. So right now, I feel that becoming a subject matter expert on the sweat equity side, again, figuring out, helping these investors that have the money, helping them find deals, and then figuring out a way of sharing ownership in those deals, helping them manage and run those deals as well. That's a faster way of wealth building within real estate. But that, again, is assuming that that's your goal to in a short span of time, generate enough equity in various real estate deals. But again, if the goal is to slowly and steadily, again, be a landlord and slowly build that, because again, not everybody is in the brokerage field. There's people who want to dabble in real estate, but also are limited with their time. For them, obviously, that's harder to achieve, again, being the bird dog in those situations. So for them, yeah, that might make more sense. Find a good asset that is below market value, put the $50,000 down to acquire it, rehab it, rent it, and again, slowly and steadily go from there.
Well, I appreciate the perspective because one, it shows There's not one way to go about it.
Absolutely.
And I know a number of people that did start the single family. They realized this is a lot of roofs, this is a lot of HVACs they can break. Let me consolidate that. Then they go get apartments. Then they, next thing you know, they're building industrial, whatever. That's one route, right? Or it's like, hey, I have my 2 rentals and I'm investing in, some crypto, some stocks, some rentals. That's fine too. And they have their W2, right? That's okay. But they still need to make a smart decision when they're buying, when choosing to allocate that capital and however much is going to go into real estate. But what I think you just shared that we haven't talked a lot about on this podcast that I am somewhat familiar with is this whole idea of like basically becoming a GP by being the deal finder.
Yeah.
Like the 2 and 20 model in private equity is really powerful. I've wanted to do it, but for the listeners, what that essentially says is you put in 2% equity, you get 20%. You put in 2% of the initial cash, you get 20% of the equity. That's how private equity and buying businesses works. These private equity shops, they use other people's monies and they put in a tiny bit of capital, sometimes no capital, 0% if they're the ones doing it. And then if the deal performs, they'll get 20%, whatever percentage in the agreement. But if I found a great deal, hey, Sib, you're selling, let's just say, God forbid you had a bad thing happen and you have to sell some sort of property super quick. You share it to me. Great. What I'm going to do is take it, try to negotiate for the best deal, and then bring on someone that has the capital to buy it. And maybe I'm putting in this much sweat equity, 2%, 1% even, maybe 0% even if I can negotiate it. Someone is bringing the 25%. And then the bank's bringing the rest, right?
Absolutely. And
that is how you build explosive wealth.
Absolutely.
Easier said than done. But I mean, that's how all these guys in Indy that I've talked to that do apartments, and that's how they all did it.
Absolutely. Absolutely. That's the only way of growing your wealth, starting with the limited wealth, growing it in a very short span of time. And again, there's no substitute to subject matter expertise in that. The only way somebody's going to give you a share of the property where they're putting in 100% of the equity is because they are deriving that value from you that they otherwise would not have. So becoming that subject matter expert, that all these neighborhoods, that where what the economics of these neighborhoods are, what asset classes are performing well, where the trends are headed, where the puck is today and where it's going to be. Again, is multifamily going to be performing very well, or is it getting overbuilt and there's another asset class that's going to do well? Same with neighborhoods. Is this neighborhood going to be growing because there's an employer going in there, or the city's investing this money in there? All those things, if you know those things like the back of your hand and you can speak to it when you're meeting and networking with investors, they'll know that this is the guy that knows what he's talking about, is going to help me make money. And obviously, if he's going to make money in the process as well, then I'm all about it.
Yeah, I mean, there's names we could mention, which I'm not sure if we need to. Just with BAM Capital and Helix, that's what those guys essentially did, but they didn't do it when interest rates were high and there was cap rate expansion. They did it right as interest rates were low. And there is cap rate compression. And all of a sudden, their 1% to 2% equity they put in to these apartments or properties, whatever it is, just exploded because they appreciated so much.
Absolutely.
Through the marketplace, these things are all worth double. Yeah. So, I mean, it's still the same fundamentals for the people listening. It's still buy good real estate, wait, but,
and history does tend to repeat itself. So the good thing is that you guys are studying the past. You guys are studying what works, what does not work. And then, again, staying in the market and be ready for when the opportunity arrives, because you've already studied it. You understand how these things function, how the real estate market, how the cycle, how all those things work. And when those opportunities are ready, you guys are ready to pounce.
And I think in that fundamental, it's the relationships too, right? To be able to get to those deals. I feel like that matters more than anything else.
Yeah.
Absolutely. Right. How did you get into the Bloomington game? I'm assuming there were some relationships.
Yeah. And Bloomington is small enough that you are able to obviously connect with people easier, but at a more macro level, the same principles apply in Indy as well. relationships, networking, talking to people, adding value to people. I think that is the best way to develop those long-term trusting relationships. So yeah, put yourself in those situations where you are able to interact with high net worth individuals that are investing, that are interested in investing in real estate. Have conversations with them, like show your value to them that you know what you're talking about regarding the real estate game. And when opportunities arise, try to understand what kind of properties they're interested in investing in, what kind of return that they're looking for. Armed with that knowledge, then when those opportunities arise, like, and obviously be on the lookout for those opportunities. And when they arise, like, I think it'll be an easier sell to those investors. But that'd be my suggestion. That long term, eventually, obviously, when you've built enough capital, then you basically flip the role. Then you're the asset allocator that's then putting the money in those different deals.
You
and
just sit back, my
you just enjoy and like
and send you the deals.
People are bringing deals to you at that time. But at this point, you're the person that needs to be finding and structuring those deals and bringing them to people and keeping a slice of equity in those deals.
You gotta hit the bootstrap, get on the ground, and
absolutely
build your way up. You know, through the education. Well, Sib, we loved having you on. Before we let you go, we have 3 questions to wrap up the episode. Kick it to Tyler first.
Yeah, what is a habit that has changed your life?
I think I have gone from being a solopreneur, where most of the deals that I was doing was basically just me, and I learned the value of teams and partnerships and relationships. So I pivoted from my friendships being just purely friendships to them evolving into a more holistic relationship where, again, we're helping each other out, like grow in each other's businesses, giving each other advice as well. So I think that habit of being proactive about seeing like what my friends around me, what their needs are, what they're working on, and proactively giving suggestions, advice, input, being a valuable resource to them. I think it's very synergistic in the sense that
it's also more of a kingdom-based paradigm. Right?
Absolutely,
it's not just me, my wealth, and my family. It's actually there's bigger, important things. Right?
Absolutely. Yeah, and that abundance mentality, I think that like just grows the pie for everybody then.
Yeah, that's a huge principle that if you can give up your own, you can sacrifice your own and give back to others.
Absolutely.
It's like it comes back tenfold.
It's very fulfilling. Absolutely.
What's an area of your life you're focused on growing?
Man, right now it's so I have a 10-month-old baby. So being a father, I think that is like one of the most important responsibilities and one of the most fun experiences as well. So yeah, that's a big focus for me right now. That becoming the best dad I can be.
What are some challenges that you're facing? I have a 9-month-old, so I'm right there with you.
Yeah. I do feel lucky and blessed that again I've got a very supportive spouse, so she makes that very manageable. But obviously being more cognizant of finding that balance, and because we have obviously all these competing goals, we have limited time, but we have unlimited requirements that we're getting pulled into. So prioritizing, and at the end of the day, just taking a step back and realizing, okay, this is the amount of hours that I have. This is what's important for me, and then just not doing the things that like don't fall in that top priority list.
Yeah. We have one more question for you. Before I ask the question, I do want to mention to everyone that you're coming on our next real estate masterclass on August 7th with Ethan Fernhaber. It's going to be amazing chopping it up with you guys.
Absolutely.
And I think we'll talk a lot. We'll talk about real estate, but I think we're going to talk a lot about faith and life and important, meaningful work within real estate and just building relationships in that.
Yeah, no, Ethan's a role model for me in how to truly find that balance between work and faith, and having the concept of work as ministry. I think he does it better than anybody I've seen. So just an amazing guy to talk to and learn from. No,
absolutely. He's changed my paradigm too, and to what's at the top of the hierarchy. Is it, what and he really exemplifies what if you put redemptive seeking at the top.
Yeah.
And it's been cool to get to know him more. So people can come out and meet you and meet Ethan. But super important question: what is your favorite date night spot in Indianapolis?
Right now, so my wife and I, we were in Indy downtown for around 7-8 years. Really enjoyed that as well. Vida used to be our spot over there. With the baby, we moved to Westfield recently, and Monterey in Carmel downtown. That's a good one as well. So that's our spot these days. So
What's
that's
the
where
thing
we
on the
can be
menu to
found.
get?
Man, their ramen noodles are amazing, and they're a twist on ramen noodles because they're actually dry ramen. So something different but delicious. So I would highly recommend you guys try it.
There we go.
We gotta
Now
go
you
check it
know.
out. Yeah.
Yeah.
Well, thanks for coming on the show. Where can
Such an
people
honor,
find you?
guys? So I've taken a step back from real estate, pivoted to, went from being an asset deployer to an asset allocator. So I'm a private wealth advisor now, helping investors with just their holistic investing needs.
So if you want all this knowledge bottled up and then helping you deploy capital, you can have him on Drip.
Absolutely.
I mean, that's incredible.
Yeah.
I don't know who doesn't need
You gotta
that.
go sign up. Well, this has been another episode of the Roots Podcast. Thanks for watching. Make sure to subscribe.